Hey, it's Darcy McConvey, and this is the Venture and Gains podcast. The purpose of the show is to connect people to other great people, ideas, and opportunities. Everyone has less than a handful of people in their network where it seems like there's something different about them. Everything they touch seems to turn to gold. These are the podcast guests. We catch them at various stages of their career, learn from how they think, so we can connect the dots and apply it. Adam is a great conversation and a charismatic character, and the English/Texan accent certainly helps. He brings a very interesting and timely perspective to digital marketing, specifically as it applies to real estate syndication online. As he notes, this will only get bigger, and the idea of creating an automated engine that allows for spending less time raising capital and more time creating value is a powerful concept. The concept applies to almost every market, transferring the spoken word into recordings and content in a way that converts your entire story, uniqueness, history, track record, value prop to attract and convert leads. Enjoy this great chat with Adam Gower. Welcome back to the second season of the Venture and Gains podcast. Like most episodes, very excited to have Adam Gower on the podcast. Adam he's a magic man, helps real estate professionals find more investors and raise more capital. In the job that I'm in, that's quite a skill that I would like to employ. But Adam, welcome to the show. We'll get into it a little bit more as we go. Welcome.
Darcy, what a pleasure to be here. And by the way, I just want to say thank you very much for calling me a magic man. I want you to know my kids always remind me there is no such thing as magic.
Well, there you go. Well, on that note, you're a doctor.
I am a doctor. Yeah.
So you're a doctor of what?
So my PhD was actually based on an examination of an obscure period in American banking history, where I looked at the underwriting of risk for a particular event and analyzed how a bank had mitigated risk in the early 1900s, actually. Very technical, but I was actually really enjoyed it. You know, I'll tell you what, Darcy, you know what I learned the most from getting a PhD?
What's that?
Was the discipline to examine absolutely every possible source of information that exists around the topic. And it's very similar, I find, to the way that you should, or that I think sponsors should look at real estate projects. Leave no stone unturned. Look at absolutely every piece of information. Don't leave a single thing open to question.
I wonder on that is, sometimes how do you know where to look? How do you know what you don't know?
Well, I think you dive down, you drill down on, first of all, you start at the basics. And I'll tell you the best place to do it, or the best way to do it, is I learned this when I was running a division of Universal Studios running a division building real estate in Asia Pacific for Universal Studios in Japan. And for one reason or another, my direct report, I was president of Asia Pacific, and my key direct report above me was an accountant. And he saw the world, Darcy, through the cells of a spreadsheet. So we started with the spreadsheet and analyzed all the costs, all the expenses, all the overhead, et cetera, and all the different revenue line items. And for every single cell on that spreadsheet, I had to justify the number. Whatever that number was, I had to justify it. So if there was a cost line item for steel, right, whatever that was, for example, I had to demonstrate that I had underwritten that cost as best as I had to have 3 bids. I had to have them in writing. I had to have spoken to people. And if there was a massive variance, I had to know why. So that was how I really learned to be ultra thorough, was to see the world through the cells of a spreadsheet.
So can I call you Doc for the rest of the interview?
You certainly can. Yeah. You know what? Can I just keep on talking? I know this is your podcast, but I'll say something.
Well, you're the guest. That's the whole point. I just let you go. I wind you up and let you go.
I have taught at university. I learned to teach by setting myself up to learn to teach some courses at university in real estate investment and finance. And I used to like to tell my students, when they said, how should we address this? Well, I am a doctor, you can call me Dr. Gower, or you can call me Professor Gower, or if you want extra credit, you can call me Your Majesty, which is what I programmed Siri to call me. So that's what I used to tell them.
That's classic. So you go from detail-oriented underwriting, it sounds like, to today building best-in-class digital marketing platforms for real estate developers effectively, and ultimately syndicating their equity online. So really a master of creating, now your magic, your doc, and your master and a majesty of creating crowdfunding platforms for developers effectively is what it sounds like.
Yeah.
So how'd you get from underwriting to here?
Yes. So the pathway to that was quite interesting. So after I finished running Universal Studios in Asia Pacific, and this is, gosh, I hate to think about the time scale that I've actually been alive. But about over 20 years ago, beginning of the 2000s, I moved back to the United States. I started doing my own investments, my own developments, right, on my own nickel, and raised a lot of money to do active developments. And in 2007, got really panicked, actually, about what was going on in the market. There was something going on. I couldn't tell you what it was at the time, but I knew I didn't like it. So I sold my entire portfolio. And just as I closed these sales, the bottom fell out of the market. It saved my life. But I had a lot of cash going into the downturn, and I was hired by a major bank to go in and help them clean their balance sheet. Basically, they'd done a lot of lending to real estate companies. They had billions of dollars of real estate collateralized loans that were going bad, right? Were not being paid. So I went in there and I worked on their balance sheet, working on divesting these notes. And then cutting a long story short, when I left the bank, I was hired outside of the bank to a Hong Kong Chinese investor who's major player here in the States, Goodwin Gore Capital.
Okay.
And he had me run a fund. And this was all during distress, right? Downturn. And I ended up trogging off over to Colony Capital, where I was brought in to do more divestments. They'd done 7 billion of divestments with the FDIC. 7 billion of acquisitions with the FDIC, all of distressed real estate notes. And then for me, that was a really good time. I'd say that it was a dark time for a lot of people, but it was very good for me. And when the market picked up, Darcy, all that good stuff went away, all that good distress stuff went away. So I decided to look at doing some other kinds of investments. You know, I'd had a good run. And so I started investing in, or joined some seed groups, some angel groups, and started investing in startups, these little student-led tech startups. And they were talking or speaking a foreign language. And the language they were speaking was the language of digital marketing. And they were using terms I had zero clue about, like funnel, CTA. I mean, anything, like some of the stuff that I can't even think of the words that they were using that were foreign to me because they're so natural to me today.
Yeah, now you use them and I'm confused.
And they were completely foreign language. And around the same time, the laws changed in the United States that suddenly allowed real estate developers to use digital marketing to syndicate their deals. And I put two and two together and I thought, my goodness, I've spent my whole career raising money in person, doing these dog and pony shows, excuse my language. And now I can automate that using these techniques that these students using to like create these incredible unicorn companies, right? They're using the same techniques, and I can apply that to real estate. So that's where I started. I thought, this is really interesting. And so I basically taught myself how to build websites, how to edit audio, how to edit video, how to record audio. I mean, really, I taught myself everything. And that was really kind of the transitional moment in my career.
It's incredible. So thinking about it now, one, real estate is, it seems clear why you picked real estate of all the different sort of, investment verticals, because that's your background. But what do you think, and then we'll circle back, the future of crowdfunding looks like? And the reason I asked that is you said, it used to be belly to belly in the dog and pony show, or however you framed it.
Yeah.
And, conversations are still important, but it seems to me, it always strikes me as odd is how people don't, not to say that I have like optimized their LinkedIn profile or done certain things to make their digital presence really stand out, because it seems that a lot of work, capital raising in particular, is going to happen digitally going forward. So what do you think the future of crowdfunding looks like?
So it's just going to get bigger. When it started, the deals were really tiny. In fact, I wrote a book on this, on the origins of real estate crowdfunding called Leaders of the Crowd, where I interviewed people in the White House and at Congress and some of the early adopters at some of the crowdfunding platforms. And their first deals were in the tens of thousands, Darcy. Now you're looking at deals in the tens of millions. We financed a deal this last summer that was over $20 million. 15 million we raised in 15 minutes. I mean, it's just incredible. And so if you look at both the volume of activity in real estate crowdfunding, that's going up rapidly. But also if you look at the trends within that trend, what you see is that the size of the deals are also going up. And there's also smaller people, smaller sponsors coming in as well. So it's flushing out more, it's getting broader at the base, but at the top, the scale is going up as well. The size of the deals is going up. And the types of companies that are discovering crowdfunding are also getting broader. That's just to get more institutional. I mean, you guys, for example, right? Classic institutional, high level company looking at crowdfunding, doing crowdfunding. You are leading the field, basically. There will be more companies like you of your scale that will follow in the next year or two.
Yeah, like I think crowdfunding has a certain connotation around it. Like sometimes it's people classified as direct to investor, so they don't feel so much like they're a crowdfunding platform for whatever reason. And I think that negative connotation comes around like issuers or managers that need capital may not have the best deals, and the issuers with the best deals have enough capital, and so they wouldn't need to crowdfund. So how do you tackle that question around, the best investors may not be on crowdfunding platforms because they don't need to be. So by default, the people that end up on crowdfunding platforms or crowdfunding are maybe not the best place to put your money. And I'm not saying that's the case. I just wonder how you sort of think through that.
So I totally hear you. Basically, so crowdfunding does have negative connotations. And that's because I think originally crowdfunding, well, first of all, the term was never applied to real estate. In fact, when the Jobs Act was passed and crowdfunding became legal for real estate, it was never intended for real estate. The Jobs Act was, Jobs is an acronym for Jumpstart Our Business Startups. It was intended to boost liquidity to small businesses. And by accident, an unintended consequence, it benefited real estate more than any other industry. And the reason for that is that every real estate deal that is done uses a small company, right? Every deal that's done, somebody forms a new company to do that deal. That is a small business. And as a consequence, real estate has benefited and actually been the biggest beneficiary. So that's number one. Number two, actually, crowdfunding. So the term crowdfunding certainly has negative connotations. And I have clients that say, yeah, when I first did this, I thought it was, before we did it, we thought it was flaky. And these are, by the way, major billion-dollar companies that come to us and we build these systems for them. Yeah, we thought it was flaky, but now, we absolutely can't do without it. And really, the term crowdfunding is a misnomer. It's really just syndication. That's all it is syndication. And syndications, real estate syndications, and syndications in general have been around. So part of what I wrote about in my PhD have been around since the Civil War, the American Civil War, the last American Civil War, by the way, and were used to build American infrastructure. The railroads were syndicated to private investors. Right? So syndications have been around for a very, very long time. And crowdfunding is, by any other, what would it say? A rose by any other name would smell as sweet. A syndication by any other name would still be crowdfunding, right? Basically, or something like that. You get the general idea. So forward thinking, here's a thought. Would you prefer who you invest in? Okay, let me back up. A sponsor, anybody who understands real estate, until I started doing digital marketing, it was all I did was syndicate deals. A sponsor basically spends huge amounts of their time raising money. They spend time with the banks and haggling with banks, and they go out and they spend a lot of time schmoozing investors to get them to invest in their deals, right? It's a long process. They have to talk about their backgrounds. They have to explain themselves to, their track record, their philosophy to investing, and then they actually have to pitch a deal, and they do it one at a time. With each investor, it is very, very time consuming. That's the term, dog and pony show. There was a term that I heard when I was first syndicating in the early 1980s, or mid 1980s, when I was first in real estate. So they spend a lot of time doing that and less time on stuff that really matters for making money. And that is underwriting deals, finding deals, making sure that execution on deals is being done to the optimal level. Mm-hmm. So I would turn the question back to you and say, well, who would you rather be working with? Somebody who has automated their processes so that they are able to focus on what really matters, and that is the deal itself, or somebody who is out there spending all their time trying to pitch people like me to invest with them. I would much rather they made it easy for me to understand what they're doing so that I can understand the deal without being pitched, right? I can understand who they are. I can learn about them. I can learn about it in my own sweet time, using my phone, using my computer, and not think that I'm spending hours on the phone with this person. All these other investors are taking his attention away from actually doing the deals and finding the deals, right? It's
a good positioning. Like, I think you'd hope that they'd have both sides of the house, like a capital side and a sort of asset management side. But you're right. Like, I think that's what it comes down to. People that are investing or managing the assets, looking for deals, just want to be doing that and don't want to be raising capital. And this sort of fills that void for them. So, it's a great point. So how do you feel, and this is on this tangent a little bit, sometimes these $5,000, $10,000, $25,000 minimums, does that sort of brand a company one way or another, whether it's right or wrong, whereby, high net worth investors or family offices or, institutions look the other way because they're on a crowdfunding platform that caters to people per se, or accredited investors versus, highbrow investors?
So I'm going to try and look something up while we're talking. I'm going to attempt to multitask, which is not very good for me, but I'm just going to run a quick search here while I answer that. So you're asking essentially the same question, I think, but just positioning it slightly differently, right? And that is the idea that institutional capital will frown upon deals that somehow are beneath them because the sponsor's gone out and raised money from, the doctors in the local neighborhood or something like that. Right, that's basically the idea. Okay, so my response to that is institutional capital, watch out, basically, because this is a tsunami of activity that is heading towards institutional capital. I used to run an institutional fund, and it's very, very different. When you are cutting checks for or getting, when you have investors who are writing minimum $100 million checks, you're in a different, almost a different industry, essentially, right? But you are also, but the wave of crowdfunding, this alternative finance source, this alternative form of access to capital, is getting bigger and bigger. If you don't mind me dropping names a little bit, I spoke with Chuck Schreiber, who is one of the principals at KBS. And KBS are the third largest office developer in the world, right? Or office owner in the world. That's as institutional as you could possibly get, as big as you could possibly get. And I asked him the same question. Why are you crowdfunding? Why are you going out to try and get $10,000 checks from individual investors when you can pick up the phone and get a $100 million check, right? For any deal that you're working on. And this is how he responded. So basically, you have different buckets of capital that you can tap into as an institutional investor, or as a sponsor who caters to institutional capital. And institutional capital is one, but an alternative is to go to the crowd. Now, it doesn't mean that you replace institutional capital, but institutional capital might exit the market. And that's what you see. When you see downturns, major downturns, like, for example, that of 2007, 2008, right? That period, institutional capital dried up. Everybody pulled the plug on investing in real estate. And so you had all these sponsors that had access to great deals, but suddenly, because they had this access to banks and special services and et cetera, but hey, guess what? They didn't have the capital anymore because all the institutional partners had all backed out and said, no, the market's too bad. We're just going to sit back and wait. And so that created a liquidity crunch. There was no liquidity. And so that's why prices dropped as dramatically as they did. Had those sponsors had the parallel tracks to crowdfunded capital, they would have been able to go out to doctors and to tax experts and to accountants and to other professionals who have capital and say, look, we've got access to these distressed deals. Would you like to invest? And they would have been able to capitalize those deals that they were unable to do otherwise. And that was precisely the reason that the Jobs Act was passed, was to open those channels of capital. So my answer to your question is that it doesn't really matter what institutional capital thinks. The fact is that from a sponsor's perspective, best practices are to have as many options open to you at the same time in order to raise capital. And my experience is also, incidentally, that we have not seen institutional partners. Banks sometimes they don't really understand it. They're not sure. They need to be educated, right, into what is crowdfunding. But for the most part, it is not detrimental to sponsors to crowdfund, even if they have institutional partners. And by the way, just to finish up that thought, the reason for that is that all you need to do is to educate them. Anybody who doesn't really understand what it is might be skeptical and step back, just like the questions you've been asking imply and suggest that there is a negative connotation, that there is some doubt about the integrity of crowdfunding. But once you understand what crowdfunding is, you understand that it is an alternative access or alternative source of capital. And the only way that people can understand that is through education. And so you teach investors what you're doing and what crowdfunding is. You teach a doctor how to invest in real estate, what the IRR is and what cap rates are. And then he comes on board. Or you teach institutional partners what is crowdfunding and why it's beneficial as well. So it's all about education.
Yeah, no, that's a good point. It's a good point because particularly, as more and more of these pop up, it will be difficult for the everyday person to decipher good from bad because you're going to have a bunch of different platforms. Now, where do you go? Which one's best? What are the metrics? How do I really know? So I think education becomes a big part of it. I also think that, and this is maybe a business that you can go take and run with, I think that inside 3 years, as more and more of these platforms pop up. It'll be much like travel, where there's going to be an aggregator on top of all of these different crowdfunding platforms that kind of aggregate the top 10%, almost like Expedia or something.
Well, I tell you something. It's as you discuss. Look, I think that I kind of, again, if you don't mind me kind of referencing now Graybrook, but that's what you do with such finesse. That's what it makes you guys stand out. The biggest challenge is, how do you know good from bad? That was your turn. I'm kind of bouncing it back at you. How do you know as an investor what's good from bad out there? Well, you could make the same point about stocks. How do you know what's good from bad? So most people, I don't know most people, I defer all of my stocks and bonds trading to a financial planner. I haven't got the brain power to manage that as well. I actively decided not to do it because I knew many years ago that if I actually got into managing my own portfolio, it would be all I would ever do. And I'd never stop looking at the bloody stock prices. That would drive me mad. I would have to take it up professionally. I knew I didn't have the bandwidth. So you rely on an expert to manage that aspect, that portion of your portfolio, and you trust them to do it right. That's what you guys do. When you talk about an aggregator, to be able to come to somebody who sits in between you and the sponsors and who does the due diligence and does the underwriting and reassures themselves of the quality of the deal, that is very comforting. And it's not common, actually, in the industry. And that's, I think, guys like you are the ones that will really stand out in the next few years, right? As you expand and et cetera.
Well, yeah, hopefully. I appreciate that. I wasn't setting myself up for a pat on the back, but...
No, I know you weren't. But that is the point. You're like the that stockbroker that's doing, like, I don't want to think. I want to be in real estate. I don't want to have to think about it. Right? I don't want to do all the underwriting. And yet there are those who really do want to know and who do want to pick and choose, just like there are people who want to pick and choose their own stocks, right? I'm not one of those, but there are plenty of people who do.
Yeah, for sure. Okay, so let's talk about your actual business. Because we're pretty far in now and haven't really chatted about it, although you certainly have come off as a domain expert. What are the systems what are the elements to the system that you implement? Maybe walk us through that.
Right. So we've been kind of talking about the investor perspective, right? Our discussion so far is kind of how people perceive crowdfunding. And when I talked about stocks and bonds, talking about the investor perspective. So now, just to be clear, what we focus on currently is helping real estate professionals find more investors so they can raise more money, right? So that's people who are professional real estate sponsors. That's all they do. They need more capital. So really simply stated, there's not much difference between the way to raise money today than there was yesterday. And yesterday meaning in person. So the in-person world, from the analog in-person world to the digital world, there's actually not much different. The only difference is that you are transferring your message from the in-person spoken format to the same kind of format that you and I are doing right now, a recording. You are recording it and you are putting it on your website and various other like social media, etc. A lot more complicated things than just that. But you're basically putting up your message in a way that is easily consumable by your prospects. Not only is it easily consumable, in other words, it's in bite-sized pieces. So instead of having to, this again, back to the dog and pony show, instead of having to sit down with a sponsor over lunch for 2 hours and hear them pitching you, right? Nobody wants to do that. No sponsor wants to sit down and do that again and again and again. And no investor wants to sit down and be pitched. They would much rather consume that information on a cell phone or on a computer in small bite-sized pieces. So the process is to convert your entire story, your background, your track record, your history, your investment philosophy, Essentially your value proposition is to record it and break it up into pieces that you can distribute to do two things. One, online, using social media and your website to do two things. One, attract prospects. And then once you've attracted them, to convert them into being investors. And so what we do is we build the content for you that transfers your knowledge, takes it from your brain and puts it into a digital format. We break it up into a way that enables you to distribute it, attract investors and attract prospects and convert them into being investors. I hope that's not too vague. It's kind of high level explanation.
No, that's important. Of those two things, attracting prospects versus converting, I'm guessing everyone wants to attract more and more because they're comfortable converting by phone, but I guess, or, in person historically. What do you see of those two elements being the more difficult of the two now that it's digital?
They're actually one and the same. So attracting and converting end up being the same thing, because the way to think about it is you've got to think of the investor journey. So let's just spin back for a moment and think about what the investor journey is in the in-person world. The investor journey is your name is given as a sponsor to a prospect. It might be through an introduction through an accountant, all right, or another investor. So you get an introduction for the first time ever. That prospective investor, here's your name. Then you arrange by phone or email or however you do it, you arrange to meet with them. Right? In the good old days before COVID, you'd actually meet in person. So you might meet for lunch or in a boardroom, or you might arrange to play a game of golf or whatever you're planning to do. And you have a meeting. And during that meeting, you explain your background and you get to know them a little bit. And then you have a follow-up, right? And you say, oh yeah, well, look, I'm interested in learning more. So now you'll say at the end of that first meeting, hey, all right, I'll send you this document, I'll send you that document. And guess what, Darcy, 12 meetings later, you discover that really they're not that interested in investing, right? If you're lucky, they'll actually tell you, no, I'm not actually going to invest, right? If you're lucky. If you're not lucky, they'll keep stringing you along forever. And of all those people that you meet, if you're really lucky, 1 in 100 might actually invest. But think about that for a second. You've got to go to the country club. You've got to join the Rotary Club. You've got to, I forgot your question already, but I'm going to translate this into the digital world. I'm attracting and converting. So that whole process is the process of attraction and conversion. You would go to, when you go for the first meeting, have a nice shirt on, right? You have a boot, suit and tie. You'll be shaved, right? You'll be your Sunday best, whatever you want to call it, right? You're going to speak in the nicest possible terms. You'll be courteous. You're going to attract them, and then you're going to spend your time converting. Same is exactly the same in the digital world. So let's just imagine, Mr. Listener, right? Imagine for a moment that every single thing that you would say to attract and convert somebody in an in-person world, all the documents you'd send them, just think of that corpus of intelligence in one package, and now digitize that entire package into articles, videos, podcasts, whatever it is, just these small bite-sized pieces. And when you put that out on the internet, it acts as, excuse my language, but it acts as bait. It attracts prospects. A prospect will see that, and they might see an article that you've written on self-directed IRAs. I think, oh yeah, I heard about that the other day. Real estate, I can use an SDIRA I've never thought of that. Let me see what this fellow's talking about. And he clicks on the link and goes to your website. Or it might be learn how to save taxes, right? In real estate. Well, that's interesting to me. They'll click on that. Or what's the IRR? And they click on that. That's the attraction, right? So whatever's out there, something is going to attract your prospect in. And because it's out there and it's digitized, once they've been attracted, they're going to be attracted back to your website, this center of gravity. And at that center of gravity on your website, having been attracted there by one piece of content that you might have on social media, they are now going to start to research more stuff. They read that article, and there's a link in that article that says related article, and they click on that. And on that related article, there's a video of one of the principals talking about a certain concept. So they watch that. Now what's happening is they are moving from being attracted, slowly learning who you are. The investor journey is slowly converting them into having a desire to invest with you before you even ask them to invest. They are, by consuming content on your website, they are becoming predisposed to investing with you when you ask them to that. And that's why the same content serves to attract and convert. Now, there is an important moment of conversion. And that moment is when they write a check, send it to you or wire money, and sign contracts. That moment might need some hand-holding. Our experience with clients is that the kinds of conversations that sponsors have with prospects, with investors, changes. It goes from the first call being, yes, we do self-storage. Okay, yes, let me explain what self-storage is, and I'll tell you about my background. You go through this long conversation, and instead that first contact is the investor saying, I don't trust DocuSign. Can you send me the contracts by FedEx, please? Right? Or I set up my account to invest with you, but I want to use my SDIRA and I'm not sure how to set that up. Can you show me how to do that? So that's where the conversion point changes slightly. Now you're actually helping people over the finish line instead of educating them.
Yeah, because they're up the curve on the education.
Yeah.
And so all the elements are, you basically can go almost like plug into an organization, which would be, creating written content, video content, SEO, advertising, LinkedIn profile. Like you do the whole sort of run of the mill in terms of offering, or a la carte.
We build full systems. So that means soup to nuts. So including building websites, we'll build websites all the way through to, I had a conversation yesterday with somebody who actually is probably one of the most advanced developers in the country in terms of their digital marketing. And we are talking about some extremely advanced digital marketing techniques that include things like storyline pages, landing pages, storyline landing pages, which are very, very advanced. Long form sales letters, also very, very advanced. Some strategic stuff, how to bring prospects in who have never invested before and convert them into being bigger prospect or being bigger investors. We do a lot of Google Analytics at the other end. So we do from rudimentary templated websites all the way to extremely advanced analytics and marketing, full stack.
So what's been your success, and what are some of the metrics that you track?
So that's a good question. Our clients raised over $131 million last year. Right? So we just kind of did a tally of what that was in equity. That's just strictly in equity. From a sponsor's perspective, I'm going to answer that with a couple of answers, actually. The conversion metric and also lifetime value. So let me talk about both of those things. First of all, conversion is very difficult to measure because in real estate, finance, we're not selling widgets. So in a classic digital marketing funnel, you can advertise at one end, you can track an investor's, a customer's behavior all the way through your funnel, how they behave on a landing page and what they click, what they don't click, etc., and whether or not they buy, because you're selling a $20 product. And then you can tweak what you put in terms of your advertising copy to see how that affects your sales at the end. You have direct line of sight between your expenses and your revenue. In commercial real estate investing, you simply don't. All right, that's number one. So it's very technical and it's there's a manual component to understanding how well you're doing at all the conversion, because there's only one conversion point. That conversion point is sign and wire, right? Did they sign and wire? But the other thing that's important to keep in mind is lifetime value of an investor. Typically, sponsors will think in terms of how much is it costing me to raise this $1 million? Right? So if that number's 5%, that might be a number a sponsor's comfortable with. Right? That's what it's going to cost me to raise $1 million, however much they raise. But with digital marketing, the scale of what you can do in terms of capital formation is so far outstrips anything you can possibly do in person. It is impossible to do in person what you can do online. You've got to look at lifetime value. So let's say instead it costs 10% to raise that, or to get the first prospect across the finish line. So let's say that's instead of it's at 50,000, it's 100,000 to raise that first million. The fact is, though, that if you now have, let's say, $20,000, $50,000 investors, those investors are going to invest with you again and again and again and again. And those investors you didn't have before. And when you raise money the next time, how much does it cost you to raise from that investor? $0, because all you're going to do is send them an email. And as long as you maintain your communication with them and update them on what's going on and maintain good communications along the way, the chances are that they will become repeat investors over time. And they won't want to talk to you. They just won't. They won't want. They're too busy. They trust you. They like you. They want to invest in the next deal. And as soon as you send them an email and says it's open for investing, hurry up, we've sold out the last one quickly, boom, you'll finance your deal very quickly.
The scale obviously makes total sense, right? That's what the internet is. So I could go into a bunch of detail around, a lot of the stuff that you've talked about, but one thing that I'm curious about is, if you're not coming from, particularly on the advertising side, like a digital advertising sort of background, one, it can seem a little bit like a sinkhole in terms of advertising dollars, where to put them, how much and why. And then there's some complexity even around creating ads, like you were talking about, A/B testing, copy and visuals and stuff like this. So how does someone know what platform to pick, or how do you know what platform to pick, whether it's Google, LinkedIn, Facebook, or a combination, and then allocating advertising dollars to those various platforms?
So I'll tell you exactly how it works, right? Based on our experience. So first of all, having a robust social media presence is absolutely critical. Having a robust educational website is absolutely critical. If you don't have both of those before you advertise, you will be, excuse my language, pissing money away on advertising. Because the first thing that happens when somebody sees your ad is they will come to your website. Or if they're on LinkedIn, they'll run a search, right? They'll run a search in Google. And what's going to pop up is going to be your website, if you're lucky, and almost certainly your LinkedIn profile. So they're going to click on that. And that's the first point of contact. The first point of contact was the ad. The next point is what they get when they do a search. So you have to have that information in place first. If there is nothing there, right? Or if it's empty, or if it's outdated, or whatever it is, and you've spent money on advertising, now your advertising funnel itself has to carry the entire burden of attraction and conversion to get somebody to write you a $100,000 check. That is an enormous burden for an advertising campaign. So it's going to cost you a lot more to be successful doing that. If, however, your website, your social presence is robust and effective, then what happens is your advertising is not going to carry the burden at all. What it's going to do is introduce prospects to your funnels, to your website, to your presence online. That's just all it's doing, is drawing them in to your ecosystem. It's not carrying the burden of conversion. So that's number one. Sorry about that. I'm working out of the house. So I've got a mad dog in the background. So sorry about that. So the answer to your question, that's kind of the framing the picture. But the answer to your question is that once you get your presence set up online, LinkedIn is absolutely the best source for traffic, followed by Facebook, Twitter, and then YouTube. Those are your best channels. However, when it comes to advertising, Facebook is, in our experience, significantly better than any other platform. And that's where you should spend your money.
So you want to create the mousetrap, which is the website in closing, and then ads are your whatever it is to attract the mice, peanut butter, cheese.
Yes, the ads are top of funnel, bringing people in. Ads, webinars, PR, whatever you're going to do. Yeah.
So I'm offline. I'm conscious of your time, so we can sort of wind it up from here. But I wanted to hear a little bit about like client success stories, but I think you've talked about that. So maybe the next question is I shift a little bit to the personal background. Do you think that, is it a British accent? Do you think the British accent helps your charismatic personality in sales?
It's funny you should say that. I'm actually from Lubbock, Texas.
Come on.
Have you ever been to Lubbock?
I haven't, but it's...
No, well, this is how we speak in Lubbock. Well, everyone in Lubbock speaks just like I do. And every time I say that to somebody...
Are you serious?
No, of course not. And my wife always kicks me under the table because people have that reaction. It's very compelling when I say that. My wife always kicks me under the table. I stopped doing that. No, I'm from England. Yes, you got it right the first time.
And you've just kept it.
Yeah.
Where in England?
Manchester, actually, Northern England.
Cool.
I've not lived there for a very long time, though.
Well, it's been a pleasure to catch up with you. I think that, anyone in real estate who's looking to sort of create a platform, you'd be one of the first stops that they should look at, because it's huge value add. You're a really great educator, full of information, obviously full of energy and a British accent. Yeah. Couldn't recommend, guiding people in your direction, even outside of real estate. Like, I feel like, even traditional finance is lagging a little bit. If you think about growth marketing, like on the tech side, you were saying that, you were a seed investor, angel investor for a while, like they're outstanding at it. And I feel like some of the older industries are lagging, but, hopefully catching up. So whether it's real estate or other, I think it's a massively valuable service. I think, you do obviously a great job, and you're a pleasure to talk to. So my last question, though, is random, but hopefully it throws you for a loop like your Lubbock accent is, if you were to pick one song to karaoke to, what would it be?
Oh my goodness. Good song to karaoke. It's good. When I was in Japan, I used to I'm not, by the way, I am not going to sing it. There is a house in the rising sun. There was a house in the House of the Rising Sun. That was the one I used to sing in Japan when I karaoke, but only when I'm 2 sheets to the wind, or however, but 3 sheets to the wind is the only time I ever karaoke.
That's fair. Most of us are the same. All right. Well, that was great. Appreciate it. It's been a pleasure. Good luck. And hopefully we'll be in touch soon.
Darcy, thanks so much for having me. It's been a real pleasure. Thank you.
Your time is valuable. So thanks for joining us for this episode of Venture and Gains, where we connect great people, ideas, and opportunities. It's this idea of net weaving versus networking. Stay healthy.
Darcy McConvey is a director of private capital markets at Greybrook Realty Partners and is registered under Greybrook Securities, Inc. The opinions and statements expressed by Darcy and the Venture and Gains guests are their own, and they do not reflect the opinions of Greybrook Realty Partners or Greybrook Securities. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.